Welcome back, my awesome people. In today's episode, I will be highlighting the 6 types of market caps and why they are important to your decision making when buying stocks. So, what is a market cap? Well, market capitalization, or market cap for short, refers to the market value of a company's equity. It is a simple but important measure that is calculated by multiplying a company's shares outstanding by its price per share. For example, a company with 20 million shares at $100 a share would have a market cap of $2 billion. A second company with a share price of $1,000 but only 10,000 shares outstanding, on the other hand, would only have a market cap of $10 million. Using market cap to show the size of a company is important because company size is a basic determinant of various characteristics in which investors are interested, including risk. So don't think that the bigger market cap of a company means it is a good or great company. There are advantages and drawbacks to having a large market capitalization. On the one hand, larger companies might be able to secure better financing terms from banks and by selling corporate bonds. Also, these companies might benefit from competitive advantages related to their sizes, such as economies of scale or brand recognition. And on the other hand, large companies might have limited opportunities for continued growth and may therefore see their growth rates decline over time. So watch to the end of this video and you will learn what each market cap means and their pros and cons for your portfolio. So get bullish on that subscribe button for the YouTube algorithm and smash all the likes, bells, and whistles to help the channel grow and to get all my updates on many fantastic investments. And comment below because I do reply to every comment. And if you are watching this video and do not have a Wealthsimple trade account and you want free money to trade with and $0 commission fees that won't eat into your profits, look at all those perks. Sign up with my Wealthsimple link in the description box below for $25 of free real money to trade with. Link is below. So let's begin. Here are the 6 types of market caps and the pros and cons of each one. First is the mega cap, which has a market cap of $200 billion or greater and refers to companies who boast strong brand recognition and operate in major markets around the world, such as Apple, Amazon, and Facebook. Due to the market value weighting of indexes, mega cap stocks have been in a unique position to sometimes lift or drop an entire index based on their stock performance. Mega cap stocks in the past have predominantly been in the energy or transportation sectors, such as those in oil or railroads. But today, many of the largest companies in the world are tech companies, such as Tencent and Amazon. The stock market, as measured by the S&P 500, is being led higher by a handful of mega cap tech stocks. This concentrated leadership has investors worried about the potential for another tech bubble. If these select stocks were to experience a downturn, it could have a significant impact on the broader market. Second is large cap, or sometimes known as big cap companies, with a market cap of $10 billion or greater, and they represent approximately 93% of the total US equities market. Since large cap stocks represent the majority of the US equity market, they are often looked at as core portfolio investments. Generally, large cap companies are used as long-term investments because of their stability and dividends. While they do not offer the same growth opportunities as emerging mid-cap and small-cap companies, large-cap companies are innovative market leaders. Third is mid-cap, which has a market cap between $2 billion and $10 billion and falls in the middle between large-cap and small-cap companies. For companies, some of the appealing features of mid-cap companies are that they are expected to grow and increase profits and productivity, as they are in the middle of their growth curve and are useful in portfolio diversification because they provide a balance of growth and stability. profitability. Since they are still considered to be in a growth stage, they are deemed to be less risky than small caps, but more risky than large caps. Successful mid-cap companies run the risk of seeing their market cap rise, mainly due to the increase in their share prices, to the point where they fall out of the mid-cap category and jump to the large cap category. The fourth market cap on my list is the small cap, which has a market cap between $300 million and $2 billion. The advantage of investing in small cap stocks is the opportunity for growth opportunities. Small cap stocks have historically outperformed large cap stocks, but have also been more volatile and riskier investments. One benefit of investing in small cap stocks is the opportunity to beat institutional investors. As a general rule, small cap companies offer investors more room for growth, but also confer greater risk and volatility than larger cap companies. However, for self-directed investors, spending the time to sift through small caps to find that diamond in the rough that will go to the moon can prove to be time well spent. Even in our data-rich world, great small cap investments fly under the investor radar because of thin analyst coverage. The fifth market cap is the micro cap, which has a market cap of $50 million to $300 million. Micro cap stocks tend to have greater volatility and greater risk than larger cap stocks. There is limited information on microcaps, making research extremely important to avoid fraudulent stocks and other potential pitfalls, and they are usually limited in liquidity due to the lack of institutional investors. Microcaps also have a reputation for high risk because many have unproven products, no solid history, asset sales, or even operations. So overall, microcap stocks represent a high risk, high reward opportunity for investors who are willing to do more research on the company involved to determine whether it is worth the investment. And finally, the nano cap, the smallest market cap, which has a market cap of $50 million or less, and are small, publicly traded companies that are very risky because they are such small companies and are prone to manipulation. Nano cap stocks are also referred to as penny stocks and are quite popular with traders who have a large appetite for risk. Many people new to trading may look for higher risk investments like nanocap. Nanocaps increase the risk versus reward even more, as short-term returns can be in the double and triple digits, but also losses can be in the double and triple digits. Nanocap stocks are prone to these fluctuations because they are not as rigidly regulated as larger cap stocks that trade on reputable exchanges like the New York Stock Exchange or the NASDAQ. And many will have reporting gaps, unaudited documents, and other red flags that should discourage even the most risk-seeking of traders. So beware and do your own due diligence, especially on nano stocks. Now to summarize. Market capitalization, or market cap, relates to a company's stage in its business development. Typically, investments in large cap stocks are conservative than investments in small cap or mid cap stocks, potentially posing less risk in exchange for less aggressive growth potential. That's why many investors diversify, maintaining a mix of market caps in their portfolios. When large caps are declining in value, small caps or mid caps may be on the way up and could potentially help compensate for any losses. As such, market capitalization is a useful figure to examine when trying to understand a company's structure and profitability, and therefore a stock's value. It can be used to determine a variety of key performance metrics, including price to earnings and price to free cash flow. The investment community uses this figure to determine a company's size and basically how the stock market is valuing the company. So it is important to build a portfolio with a proper mix of small cap, mid cap, cap and large cap stocks. You'll need to evaluate your financial goals, your risk tolerance, and your time horizon. A diversified portfolio that contains a variety of market caps may help reduce investment risk in any one area and support the pursuit of your long-term financial goals. Keep in mind, diversification does not eliminate risk or the risk of potential loss, so do your own due diligence. And again, if you are watching this video and do not have a Wealthsimple trade account and you want free money to trade with and $0 commission fees, again, look at all those perks. Sign up with my Wealthsimple link down in the description box below for $25 of free real money to trade with. Link is below. So again, I am not a financial advisor, so make sure you do your own research and consult your own financial professional. Thanks. There is so much wealth out there for all of us to get a piece of. So by allowing our hard-earned money to make us more money is the key to wealth and the key to financial success. So subscribe, like, and share to help out the channel, and so you will get notified of when I post my next Wealthsimple Challenge update, my penny stocks, REITs, dividend stocks, and speculative stocks, and any other investments that I am buying and selling. I want everyone to have the opportunity to get out of this work-life trap by buying back their freedom through investing. So let's all ride 2021 together on a journey of health, love, success. So until the next video, stay ranting.